Thanks everybody for logging in. My name is Rich Gannon. I'm a small business advisor with the Montana Small Business Development Center and the Great Falls Development Authority. Quickly, I'd like to thank the sponsors of the small business webinar. Of course, the Montana Small Business Development Center, the Montana Department of Commerce, MSU Extension, Montana Economic Development Association, U of M, and the Great Falls Development Authority. And as I noted earlier, this session will be recorded. So if you want to refer back to the recording of this session, visit the webpage that you found this webinar on. The recording will be posted in a few days. And you can also check out some of our previous offerings there. Next, we'll give a little plug about next month. I'll actually be hosting next month's webinar, and that is going to be, the topic is going to be using artificial intelligence, and in particular, Chat GPT for use in marketing. Pretty powerful tool I've been playing around with. So if you want to tune in and see if the robots are going to kill us all, check out that webinar. Throughout the presentation day, please put some questions into the chat if you've got questions. Steph will try to grab those while she's presenting. If she misses one or two, I'm going to interrupt her and ask her to address those questions. And then at the end of the session, you can unmute yourself and ask Steph some questions directly. So with that, Steph Albano, she is the owner of Hatched Concepts. She is a previous business owner and a business consultant. She helps businesses with everything from marketing to financials. And today she's going to be presenting on how to understand your financials for better decision making. So with that, I'm going to turn it over here. Oh, if you'd like more information about Steph, you can visit her website. I'm going to drop that into the chat here in a little bit, but that is hatchedconcepts.com. So with that, I'll turn it over to you, Steph, and we'll get going.
Thanks, Rich. It's a pleasure to be here today, and I sure appreciate everybody's time. Let's see if there we go. As Rich said, my name is Steph Albano. I own Hatched Concepts. I have previously owned a few small businesses of my own and enjoy working with small businesses today on financial issues, or in some cases, just small projects that they need to get moving ahead or need to transition to the next level and need some extra help for a temporary time to do that. I previously served as a financial analyst and as director of distribution center operations for CarQuest Auto Parts. I also did some national marketing for them and really enjoyed those opportunities and working with other business owners. So thank you. As Rich said, please feel free to share questions in the chat or jump in here anytime, and we'll do our best to answer everything we can. So today's topic, again, was to cover financial statements and how you can best understand those and interpret those to make the decisions that you need to make for your business. So just like a doctor uses observation and diagnostic tools to determine your health or the best courses of action for someone's health, you can use your financial statements to do the same for your business. In this seminar, we're going to talk about a lot of opportunities to delve in a little bit and think about how we might tweak things, just as your doctor might help you tweak medications or other diagnostics to obtain your optimal levels. But the first thing I want to ask you all is, what do you want to do with your business? Obviously, today it provides you with hopefully an income, your daily endeavors, if you will, and goals. But think about if you want to gift this business to your children, if you want to sell this for a large profit someday, because your exit plan is going to determine some of the decisions you make today. I want to share a little bit of a story with you to highlight the need for your decisions on that part. When I was working as a financial analyst for CarQuest, there was an independently owned store who was owned by Dick and Jane. Those were their real names. And they made a lot of short-term decisions on their financials that haunted them in the long term. They intentionally understated their inventory for tax purposes, but in the long run, they were one day ready to sell their business, and they realized they would have to make payments against the gains that they would recognize when they sold the business. And at that point, they were in a higher tax bracket than they were when they made the initial decisions. So this recognition, if you will, enabled them to spend a few more years in their business so that they could afford to sell the business and make those tax payments in the end. So it's something you want to think about as you move through your decisions and as you look at your goals every day. So with that, a good financial statement package should entail at least a balance sheet and statement of earnings or profit of loss statement every month. It's also beneficial to have a cash flow analysis, a budget comparison, key financial indicators that are distinct to you and your industry, a monthly recap, and a general ledger listing. And we'll talk about some of the things you can glean from each of those. Why do we need to do this? Well, it keeps you informed of your financial performance against your goals. It also helps lenders determine the financial stability of the business, and it justifies reporting to taxing and governmental authorities along the way. It's important to have your financial package by the 20th of the following month so that you can make those decisions and adjustments, most importantly, that you see and glean from those financial statements. So let's jump into the balance sheet a little bit. Remember that a balance sheet is a statement of where your business is at a certain point in time. So let's say March 31st, your balance sheet is going to show you the picture of your business at that time. Let's think about the equity portion of your balance sheet. This is often intimidating to a lot of business owners, but it's much like when you buy a house and the equity you have in your home. So if you buy that home and you put down a down payment, you then take out a bank loan, and then you have equity in the house over the time that you make those payments. That equity is what you're going to walk away with someday when you sell your home. The banker's going to be paid off, and then the equity is your nest egg. Your business is no different. That net worth portion on your balance sheet is much the same as what we just discussed in a home. So if a business owner with this very simple balance sheet, excuse me, sold their business today, they would walk away with $100,000 if they in fact sold the business for the $400,000 that they show on their asset portion of their balance sheet. So let's delve in a little deeper there on how to understand your balance sheet. Assets are the items that are owed by or due to the business. So your cash, your accounts receivable, your inventory, and your fixed assets, these are in place to support your business. They're in place to help you grow your sales, to grow your business, and hopefully eventually increase your nest egg. If you want to drive your sales, you have to have, say, the inventory to do so. So any asset-based growth is requiring cash. So you can increase that inventory or other asset to drive your sales. When you look at your balance sheet, your assets are going to be ordered in order of liquidity. We generally have three categories. Cash, which will be liquidated or used within the next 12 months. Next would be fixed assets. These are things that are acquired to support your business, not necessarily with the intent of resale. So maybe a vehicle, maybe your display information or items you display your product on, your point of sale merchandise, those kind of things. They are depreciable in value. Other assets might be deposits for rent or utilities or investments in the business. Liabilities are the obligations of the business. The purpose of an obligation is to fund the assets of the business, which in turn helps you grow. Liability reporting on the balance sheet is also done in order of liquidity. Liabilities should be segregated into two categories: current liabilities and long-term liabilities, depending on whether they're going to be paid within the next 12 months or longer. Remember this formula: assets minus liabilities equals your net worth. This will play into some of the other things that we look at later, but if you can remember that in the end, and making your financial decisions, it will make things easier for you and help you determine what the best course of action will be. I know sometimes those liabilities are a little bit daunting when you take on a new business, but remember that they're there to fund our assets and our growth. If we want to have zero liabilities, then that must come from our net worth. So the net worth is the nest egg, and the only way to decrease our liabilities is to increase our net worth. The only way to increase our net worth is to bring either additional investment to the table or generate more profit. Profit is not a four-letter word. Profit is something that's necessary for every business, and you should take a look at the different opportunities that you have to increase that. Again, I want to state in going back to Dick and Jane, let's just remember that it's very important to make good decisions, and you can't make the best decisions if your financials are not accurate. Net worth would be of high importance to your banker. It's also of high importance to tax authorities and to you as you make decisions in how you want to operate your business today and how you want to end up in the end. And again, let's think about the exit strategy. Do you want to gift your business to your children or to sell your business someday for a profit? So let's think about those current assets as we value the business. As you think about the valuations listed on your balance sheet, how are you determining every month that those are correct? With accounts receivable, it's important to make sure that you know you're in fact going to get paid for what you are letting your customers charge in your business. Are you following up on those every 30 days? Are you following up on your bank balance with a reconciliation every 30 days? These things are hugely important to make sure that your balance sheet is correct. In many cases, inventory is the largest investment a business might make. So making sure that your inventory is current and doesn't have obsolete inventory. If you have special orders that you bring in for people, you have a deposit schedule for those and a way to follow up on those and make sure they're collected and paid for. If you have consigned merchandise, it's also very important to reconcile that on a monthly basis so you know that that asset is listed at a proper value on your income statement and your balance sheet. And then many of us have a large inventory and have a computer that tracks all that. It's very important to do a physical inventory and reconcile the difference between the book value and the physical inventory value that you make every month. This helps you ensure that your balance sheet is in fact correct. Fixed assets is another area that I think people often overlook. We acquire a lot of tools and assets to make things work, tools or vehicles or hand trucks or simple things that you spend money on your business in. And it's important to do an annual inventory of those fixed assets so that, again, your balance sheet reflects the proper amount. At the end of the day, remember that this does impact your tax bill, your statement of net worth, your discussions with bankers, and in the end, your nest egg. I just want to do a quick mention of depreciation. As we all know, we can depreciate those assets over a period of time, and this is done as a non-cash entry. There are two different methods to, you can have two different depreciation schedules, one for your book purposes or one for your tax purposes. If you're thinking about your tax purposes, you may want to depreciate your assets as quickly as possible. If you're thinking about getting a loan with a banker, you may want to depreciate those in a different fashion so that your asset value is higher and you can get a larger loan with your banker. So those are things to consider and have conversations with your accountant about as you prepare your books. Other assets are often things that you might have put a deposit down for the building you're in, for the utilities, but they're things to keep track of so that someday if you move or you get out of those relationships, you can in fact go back and make sure you get your deposits back or you serve the non-compete agreements in the right fashion in the end. Your current liabilities are things that are going to be paid in the next 12 months. Remember, your notes payable is not the total that's owed on a loan, but it is something that will help you recognize and deal with the amounts that are owed by you. You should also be accruing for payroll taxes, payroll itself, sales taxes, and other accrued expenses that are significant. This will help you keep the correct financial picture in mind as you make decisions in your business. Let's take another quick look at your net worth section. You're going to show your original investment in the business, your retained earnings, which is the accumulated and retained net profit or loss since you've been in business, and then your current earnings. Your current earnings are generally rolled into your retained earnings once a year. But it's important to track those things so you can see the progress that you're making as you go. If you are a sub S or an LLC, you might have different input as to whether you have distributions or owner's draw, but those are things that are going to show in your net worth section as well. It's important to recognize that the statement of earnings, or a P&L, is a statement of how you got there. So if our balance sheet shows where we are as of March 31st, the statement of earnings would show where we are as of from March 31st to the end of the month. It's what happened during that time period. So we had 300,000 in sales, cost of goods sold at 200,000, your gross profit, your expenses, and your current profit. This allows us to see what we did and what areas we can improve upon. It's important to recognize for a minute that our sales do not generate the funds that we can pay bills with. Our gross profit generates the funds that we can pay bills with and also fund our nest egg with. So with that, it's important to recognize how much of a sale is going to help us grow that nest egg or pay the bills that we need to pay. And if you have different types of sales in your business, say charge and cash, it's important to track those separately so that you can see the profit that's generated by each section and the growth, hopefully, in each section. If you have a business where you're allowing others to charge sales with you, or you have an accounts receivable for those folks, it's important to recognize what service you're providing and what profit that's bringing you. You may be charging them, you may be allowing them to charge sales at a different profit margin because they're buying more than someone who might just come in and buy 1 or 2 widgets over the counter. When you calculate your cost of goods sold, there are 4 different methods to calculate that, and it's important to meet with your accountant to determine which is the best method for you. It's also important to recognize that you use a consistent method to calculate those so that your gross profit, net profit, and essentially your nest egg are calculated at the same value and remain consistently accurate. As you look at your expenses on that P&L, it's important to segregate them as well. Let's make sure, for example, that your facility that you're operating out of is in fact tracked, and you know the expenses that are associated with that facility, so that when you continue to grow or you look at new opportunities to expand, you know exactly what that facility costs you, and you can make decisions to grow or change locations as you need to. As we all know, we get to deduct some expenses and some are not deductible, so it's important to stay current on that. You can work with your CPA, or you can try to stay current on that yourself. But for example, we used to deduct all of the meals and expenses. That is recently changed to only be able to deduct things that happen in restaurants. If you go to a grocery store and buy things now, that is not deductible at the same rate. Last year, we also had a change in the mileage that we can deduct. I think that changed in June. So there was a certain time period, January through June, that you had one amount to attribute your mileage to, and then July through December, that was a different amount. So it's important to stay on top of those things so that you can, again, put yourself in the best light for both now and whatever you want to do with your business in the end. It's important to recognize that the depreciation we spoke of earlier will show up as a non-cash entry, but it is relevant when you look at your cash flow. So I know we're close on time. We have about 10 minutes left, but I want to share some tools with you, some of those diagnostics tools that might be relevant now that we have kind of a basis for understanding there. I have heard several people say, my statement of earnings shows that I made $50,000 in net profit, but when I look at my checkbook, it doesn't really show that it's there. And so an important tool that I alluded to earlier is a cash flow analysis report. This can be provided by your accountant, and it will show you where your cash is coming and going. It shows you sources and uses of cash. So if you see an increase in, say, $10,000 in your accounts receivable, is that a good thing or a bad thing? Well, it's a good thing if your sales went up. It's a bad thing if you have customers who aren't paying and you are continuing to carry that accounts receivable. So your sources and uses can help you determine where those changes have happened, and you can make decisions from there. This allows us to look at our liabilities. It allows us to determine where our cash flow will help us and how we can continue to grow. As I alluded to, this might be an accounts receivable issue. It might be that your inventory went up and you didn't have as many sales because you brought more product in, but it will help you determine those things. It will also help you determine if your equity is sufficient to support where you're at. Key financial indicators are sometimes scary, but I think they are hugely important in helping you track things at a daily or maybe monthly, even quarterly basis. If we relate that back to just miles per gallon is something that we are all familiar with and use to maintain the health of our business. If you start to see your fuel efficiency going down, you might figure out that your fuel filter is clogged and you need to make adjustments to your vehicle. Key financial indicators for your business are no different. So we can look at a number of ratios and indicators for the business that will help us determine those things. I think it's important to find an industry association that is significant for you to relate to so that you can compare yourself to other people that are doing the same thing you do. In many cases, that leads us to the opportunity to get to know others and to look for opportunities for us to improve in our own right. So if we look at profit and loss percentage to sales, this is a great way to determine where we are on a very regular basis to see how we're operating. So the formula is net profit before tax divided by total sales. Your net profit is, again, what you can pay your bills with or fund your nest egg with. If you start to see fluctuations in this, it can tell you that you've got some things to consider. Are your expenses going up? Are your vendors charging more? Are you selling less? It's a great indicator to give you a quick tip to dig deeper into the financials. With that, how do we increase net profit? I think many people don't always remember that this is so simple. There are really only 3 ways to increase net profit. You can increase the gross profit margin on your existing sales, you can increase your sales, or you can reduce your expenses. That's it. There's only 3 options. If we jump to the net worth ratio, this is the first thing a banker will look at. It determines your assets versus your net worth. And if you remember that balance sheet formula, assets minus liabilities equals net worth, it kind of keeps things very simple. So we take our net worth divided by our total assets, and the target generally is 25% or greater. But you need to ask yourself, does your nest egg have an upper limit? I think most small business owners are working very hard. They put a lot of time and energy into their business, and you deserve to be paid for that. So if you're below that target, there's an inability to grow your asset base. Cash flow pressure is often tight, and sales and revenues can decline during seasonality or economic conditions, which we're all aware the economy is changing drastically. So when the ratio does not exceed the target, you can implement these remedies. You can increase your net worth and use those funds to decrease your liabilities. You can reduce your asset base and use those funds to reduce your liabilities, meaning sell some of your inventory or other fixed assets, or you can increase your investment by contributing more capital to your business. If you put yourself in this banker seat for a minute, and I'm the business owner, I think this is a good thing to maybe think through and recognize. If my business is on target and my net worth ratio is at 25%, if the banker gives me a loan, he has 75% of the risk. So you can see why they're sometimes picky about who they give loans to. They want to make sure that if that loan doesn't come to fruition, they have a way to get out of it. And if you can see who has the risk, that helps you understand what the banker would be looking at and how to make decisions in your business to put yourself in the best spot for you to move forward. Accounts receivable is another thing that many small businesses, in my experience, overlook. It's something that's easy to let go because people aren't always vocal about it. You want to see that your well, excuse me, just 1 minute. The formula here is this month's charge sales divided by your total accounts receivable. In most cases, you want that target to be around 85%. You want to make sure that people are paying you within 30 days, because if it goes further than that, in many cases, you're not going to get paid. This is going to impact your cash flow. And so some of those remedies would be looking at your credit policies and make sure they're being instituted and enforced, being very strict on credit limits, offering a prompt payment discount to your customers can often get them to pay sooner, and don't be afraid to assess finance charges. It's very important to stay on top of these things and to follow up on them once a month at least. Your gross profit ratio can also help you determine where you stand on a regular basis. Again, the formula is gross profit divided by sales. If you do offer those charge sales or your accounts receivable to your customers, keep an eye on the pricing schedules that you are offering. These things can often be overlooked and not reviewed frequently enough, especially with the changes that we have in the economy right now. Make sure that you are looking at quantity and seasonal discounts from your vendors as well. I think this is something, again, that many business people overlook. A 1% increase in your gross profit can yield the same amount of net profit dollars as a 15% increase in sales. I'll say that again. A 1% increase in your gross profit percentage can yield the same amount of net profit dollars as a 15% increase in sales. We all know that it's really hard to increase sales, but if you think about a 1% increase, that's not always as hard to achieve. Let's say you have a widget that's $2.84. If you round that up to $2.89, do you think that people are going to stop buying product from you? If you sell many of those widgets over the year, that's going to make a big impact on your bottom line. The other thing that I used to see a lot of in the auto parts business was people overriding pricing at the point of sale. And that's a big one to keep an eye on as well. So depending on your business, that may or may not be a factor, but think about where you can add 1 penny to a dollar to bring more impact to your bottom line. Inventory turns. If you have a large inventory, this is a huge factor, and I know it was in the auto parts business. If you take your annual cost of goods sold divided by your average inventory, that will give you your factor. For an auto parts store, we used to say turns should be 2.5 to 3 times a year. If they were not turning at that rate, we knew that either there was too much obsolete inventory, the sales didn't justify the inventory level, or a number of other smaller impacts. But it is something to, again, look for your industry standard figures and compare yourself to that and monitor that over time so that you know what your inventory is doing. If you're a business that grows exponentially, it's going to be hard to make sure that your inventory is at the right level. And if you see those turns changing, you're going to know that you need to find the asset base or cash or investment to help you grow your inventory. A budget. How many of us love to prepare a budget, either on a personal level or for our business? It's probably not a favorite activity for many of us, but it's something that can really help you understand where you think your expenses and revenues can come in and how you're doing to meet your goals as you move through. Success doesn't just happen. It's important to set that budget and to make sure that we're achieving those goals as we go. Your sales forecast can be impacted by seasonality. It can be impacted by your profit, and you've now seen some of the tools that you can use to help in determining those profit levels and what you can really achieve. The other thing is payroll expense. It's hard as a growing business to know when to take on extra payroll, and in looking at how much gross profit or net profit you need to support another employee, your budget can help you determine when the right time to do that might be. Last, the general ledger listing is something that I think a lot of people kind of shove in the drawer or the file and don't really look through, but I think it's a great tool to look through each month, and it will help you remember what expenses went into those totals on your statement of earnings, where things came from on your balance sheet or statement of earnings, and maybe take a second look at what you're spending money on and where you want to go from here. Okay, I think I'm right at the timeline, Rich. Do we have any questions? Is there anything I missed?
Nothing in the chat, but I'd welcome people if they have a question to unmute themselves. I've got a question to start it off, a couple questions actually.
Yes, sir.
So you said, you drive sales with assets, and that's really kind of, in my mind, we're talking about an inventory or a sale of product. If you're in a service industry, what's the difference there? Like if you're not selling physical goods, do you still need assets to drive sales? What would that look like?
If you're a service industry, I think the first thing that comes to mind for me would be, if you're allowing people to charge sales, or say that I worked with an ad agency recently on a project who didn't bill for their services or the display or any of the marketing materials they created until after the event that we were working toward. And so they're using their assets to help make those purchases and carry me until I pay them as a customer. And so you may not have a big investment with an inventory as a service business, but you will have an investment with your cash and your cash flow as well, in my mind.
And I think too, it's important to remember sometimes, even though you're not maybe selling a physical product, you still probably have assets associated with that product, right? So
absolutely. Great point.
The next question I had, and if anybody, feel free again to ask questions. Super good information. If you could distill it down for business owners who are so busy and don't have time to maybe do all this stuff all the time, what would be your top one or two things to say you have to do this once a month? What would those one or two things be?
I think I completely understand where you're coming from. I think taking the time to sit down and look at your financials and understand what you're seeing is huge. And maybe you don't have the time to do a physical inventory every month. That's understandable. That's something that's only done maybe once a year. Maybe you get your accountant or something like QuickBooks to calculate the ratios that are most important to your industry and to your performance. But having accurate information and taking a look at them is hugely important. If you don't know where you are, you can't get to where you want to be.
Right. And just one more point too about when you're talking about comparing yourself to industry averages. SBDC's, the Small Business Development Center, we have access to industry financial reports that can grab those industry specific comparisons for you to compare yourself to. Not seeing anybody unmute themselves. Anybody else have any questions for Steph? Once, twice, three times. Okay, we did have a question, want to know if the slide deck would be available, and yes, it will be. I believe you'll email Carrie will post it on the MSU extension page along with a link to the YouTube video of this recording today. So everything will be available there. You can go back to that for another resource. Well, all right. Well, if no other questions pop up, Steph, I'd really thank you for presenting today. Really great information. Working with small businesses, I know it's financial sometimes can be intimidating, and I think this was kind of a really good way to break that down. So I really appreciate it. Please join us next month. Again, we're going to be doing a little presentation on using artificial intelligence for marketing. So with that, we'll go ahead and sign off. Thank you, everybody. Have a great weekend.
Thank you.
Thank you.